Hello again, everyone. Welcome back to Distilling Venture Capital. I'm your host, Bill Griesinger. As you are aware, Distilling Venture Capital is your podcast for fintech, blockchain, decentralized finance, digital banking, crypto, and all of the Web 3.0 technologies that are changing the financial landscape globally. As you can see, I'm not in my high-tech fancy studio in Ipanema. I'm at an undisclosed location in the Midwest. But I wanted to change up the format a little bit since my last episode, which dropped on February 23rd. Encourage you to go back and listen to that. Also in the Unicorn Mania series. I wanted to start doing shorter videos, hopefully more frequent and more impactful in this video, I wanted to reinforce some of the things that were discussed in that last episode. I made a whole bunch of notes here since that last episode that I want to go through with you today. The episode 28 is the last episode. Like I mentioned, it dropped on February 23rd, so just over a month ago. You can find it in audio on all of the major podcast platforms. It was my first video. So if you go to YouTube and in the search bar, you type in tech unicorns are fake. So that's tech unicorns are fake. My video should be the first one that comes up. But let's get into this episode because I did a lot of post-episode notes from that last episode of Unicorn Mania, where you'll recall I went through the Stanford University study called Squaring Venture Capital Valuations with Reality, and we talked about the bogus, improper notion of value that venture capital and the tech press and others are trying to use, utilizing the post-money valuation. And I just felt that it was important to come back to you in a shorter video to reinforce some of those points. And I unpacked a couple of indexes, new unicorn index funds. And I want to just reinforce some of the points there so that you understand what's really going on in this freak show. So let me jump into it. So the post-money valuation, I call it the real facts around this nonsense. It is, let me go to my notes here. It is absolutely not the market capitalization or the market value of these tech companies. The post-money valuation completely ignores all the prices paid, preferences, and rights granted to all the prior preferred rounds and common stock, and that's a major flaw identified in the study, and I pointed out related to this bogus method of valuation that they use. So a completely distorted picture of value is created by actually assuming that all these past preferred rounds of equity plus common are all magically worth the same price as the round just completed. To make matters worse, the derivation of the post-money valuation is cloaked in secrecy. It's a black box. You don't get to see the calculation. So remember two main things from the Stanford study. And again, you can listen to the longer episode to hear more detail on that. The two main things are this. All 135 unicorns that were evaluated in the study were overvalued. So 100% of the sample was overvalued. That's number one. Number two, 65 of those companies lost their unicorn status. So nearly half of the sample loses its unicorn status, meaning they are no longer billion-dollar companies after running through the Stanford model. So this, to me, ladies and gentlemen, is a Houston, we have a problem moment. If these statistics and these metrics aren't an indicator that something is terribly wrong with the post-money valuation, well, I guess you're in unicorn land. Anyway, so to me, given the above, given these facts, a unicorn index fund is a sham. To me, it's a farce. The concept of a unicorn index fund assumes that, the reality is this. Here's the reality. Here's what's going on here. These indexes, in fact, do not have visibility into the required information and data usually used to come up with the market value of a company. i.e., how about financial statements? They don't even have that. That's why they use this inappropriate and discredited post-money valuation and then try to sell it to you as some rigorous proprietary methodology, and it's complete BS. So since the index funds don't have, they have limited information in these private companies, again, no financial statements. They're trying to triangulate, if you will, evaluation from not only incomplete information, but a methodology that's completely improper, as the Stanford study points out. So let me, and further, as I thought about this and was making additional notes, let me let you in on a key piece of information here, a key fact. I have known about the concept of the post-money valuation, that term, for more than 20 years during my time as a venture debt lender. The post-money valuation was never intended to be used for the purpose that it is today, that is trying to come up with a market value for these companies. So let me explain that a little further. As a venture lender for over 20 years, and I started in the business in 1998, so even before the internet bubble, 90 to 95% of all the deals we did, all the loans we made to these venture capital-backed technology companies, normally in 95% of those cases, they had to raise an additional round or two of capital before they paid off our loan, because these are companies that are burning through cash every month in most cases. And so under our loan, we had a very comprehensive loan and security agreement because we were a secured lender. So in the loan agreement, they were obligated to provide us with the details surrounding any new capital raise. And often when they did that, the management teams and the investors alike would tell us in that process, they would tell us that the post-money valuation after this round is X, right? So we knew how it was calculated, and we always knew that this was not the real market value for the company because of all the terms and conditions in the prior rounds were different. And so it was always considered a rough, back of the envelope way to value a company, and maybe was a very rough approximation of its future potential or future success. But in no way did it represent market value. Everybody knew that, and no one tried to suggest that it was market value. Now, in this era of unicorn mania and this freak show since, well, 2013 really, when the term was coined, unicorns, tech unicorns, a venture capital-backed company with $1 billion valuation or more, the way it's being used today is dangerous, in my view, and it's even fraudulent. The idea that index funds, the financial press, the analytics companies, and others have been trying for years to use this as a representation of value is insane, and it's wrong. So the question I have is, why would anyone invest in an index fund that can't provide investors with a true picture of value? Any index fund should be required, and investors should demand that the valuation methodology be disclosed, right? Makes sense. One would think that disclosing your valuation methodology would be a strength, a positive, to show that you do have rigor in determination of value. Transparency in that regard should be an asset, not something to be avoided. So instead, these so-called index funds use stealth methods and means because they don't want you to know. They don't want you to know that they don't really have visibility and the tools normally utilized, like financials, to actually determine real market value for these private tech firms. So, my first question is, why the secrecy and the black box approach? If the index funds are asking investors to pony up millions of dollars to get exposure to this private tech company asset category, think about it. The risks of an early stage or growth stage private technology company are high enough and significantly high based on their performance, which is not proven or disclosed. To gain exposure to this high risk asset category via an index fund with a completely improper and bogus notion of value is insane. So my recommendation to you would be, let me go to my notes here. Yeah, stay far away from anything that's an index unicorn that bills itself as an index of unicorn tech companies. Let's understand what's really going on here. I mentioned they don't have visibility into the information one would normally use to value a company or the tools. What am I talking about? Here's what you would get from actual financial statements, monthly financial statements, quarterly and annual. How about the firm's actual revenue and what we call its revenue run rate? So these index funds have no sense of what the aggregate monthly and annual revenues are and the growth rate of revenue. How fast is the company growing month over month? How fast are revenues growing? That's one. More importantly, no sense of the firm's gross margins and net operating margins, right? Is there a path to profitability anywhere in the future? If we go back to WeWork, which I analyzed in episode 6, August 2020, there was no path to profitability for that company, and yet it had a $47 billion valuation, and they dropped it before pulling its IPO in September of 2019. Regarding gross margins, and I'm not going to try and get into too many accounting terms here, but that is the first level of profit margins that you look at in a firm. The gross margins in a firm are a firm's gross margins reflect basic survivability, right? And again, these index funds have no access to that. The things we would normally use to value a company like a public company. How about the firm's performance to plan? How are they doing against their forecast? Again, they don't have that. The firm's monthly cash burn rate, that was one of the biggest measures, the highest weighted measures in our risk rating system in the venture lending space was the monthly burn rate. In other words, liquidity runway. How many months of cash based on your burn rate every month do you have left in the bank? That gives us an understanding of when you run out of cash and when you have to raise more capital from your investors. So each of these above financial metrics, again, if you look at comparables and valuations, let's just take software firms, for example. You'll see, so many times you'll see software firms valued on a multiple of revenue or a multiple of EBITDA, which is kind of a proxy for the net operating margin. Or a proxy for cash flow. You'll see multiples of those because you have and it's not, by the way, it's not black box. It's available for everyone to see. When you see a multiple, you can go calculate it for yourself from the publicly available financial statements. Each of these above financial metrics that I've just mentioned would normally be used to value the firm and measure its financial health and trajectory. These so-called index funds do not have access to any of this information and therefore operate in a vacuum. When it comes to relying on real financial metrics normally used to value a company. So my view is investors should be fully aware, fully informed of how flimsy and flawed these valuations are based on this bogus post-money valuation. So I don't want this to get too long. I wanted to come back with you or to you with that information as I thought about the last episode. I've got an idea and a request for the Prime Unicorn Index or the Morningstar Pitch Book Index. How about this? How about you just show us exactly how you're calculating the value of these companies? What are you doing? Show us the formula. It shouldn't be secret. This should be something that should be divulged as a matter of course. So again, my recommendation is stay far, far away from anything billing itself as a technology or an index of technology unicorns. Because remember, ladies and gentlemen, this guy here, fake, right? Most children know that. Most children know that this guy's not real. I don't know, not so much for the VCs in Silicon Valley and this whole circus around technology unicorns. My recommendation, and I'm going to finish with this because I don't want this video to get too long, is I believe one, these index funds and all the others who are calculating values of these tech companies based on post-money valuation should disclose how they're doing it. And number two, I think a requirement is all of these companies should be run through the Stanford University model, squaring venture capital valuations with reality, because it unwound all of the prior rounds to arrive at a true value for these companies. It's time consuming and more rigorous, but it's the way to show the value of the companies, right? And so I think that I'm going to leave you with that. That should be the recommendation. In my next episode, which I hope to get out in less than a couple of weeks, I want to dig into for you the FTX, the crypto exchange company that imploded back in November last year. Get into that, and I would also like to touch upon the Silicon Valley Bank situation and tell you what's really going on in what happened in that case and what's going on in the banking industry in general. So remember, unicorns aren't real. Tech unicorns aren't real either. Neither one. They're pretending. I think I'll end it with that. That's enough for today, but I thank you for your time, and stay tuned for the next edition, and I'm going to get into some other areas like FTX and Silicon Valley Bank. Stay tuned. Thank you very much for joining me for this edition of Distilling Venture Capital. I don't know if I'm going to have the same intro and exit music on this particular episode, Aquarela do Brasil by Gal Costa, but nonetheless, I hope you enjoyed the episode. Thank you.